Well, as we heard in Emily's report, part of the reason for gold's astonishing run at the moment is the fear that Europe's sovereign debt crisis is about to blow up again. Well, to discuss this a little more, I'm joined from London now by Jan Randolph, Head of Sovereign Risk at IHS Global Insight. Jan Randolph, welcome back to the programme. I'm not hearing you, Jan Randolph. Can you hear me?
I can hear you well.
That's terrific. All right, welcome back. It's almost a year since the Greek bailout of 110 billion euros. The debt crisis is back, we hear. Will Greece have to restructure?
Yes, it's an important question. Last week we heard new soundings from Berlin. The Finance Minister, Wolfgang Schäuble, and the German Deputy Foreign Minister talking in terms of there may have to be a voluntary debt restructuring for Greece. That's something new. Up until now, the European Central Bank and Berlin have been against any kind of restructuring. All the bailout packages in place do not assume anything like that. But the problem is Greece isn't growing after a year or so of this austerity, and that's the problem. If Greece wasn't a member of the Eurozone, they would already be talking about a restructuring.
Yes, presumably. What is growing, of course, is Greece's debt. And we're hearing now talk of Germany possibly accepting a soft landing by, say, 2013. What is actually meant by that?
Well, the idea of restructuring, which is a polite way of saying default, as long as you can get the creditors to agree on new refinancing terms. If the creditors agree, that's voluntary, and technically that's not default, but it is helping the debt situation by pushing the principal in the near term out into the future. So you give the economy a breathing space in order to grow again. And only once the economy starts growing again, the taxes come back in, and then you have a better ability to pay back on all that debt.
But what does the market think of this so-called soft default, I meant to say? Isn't it really shuffling the deck chairs, as you seem to describe?
Well, yes, there's a big difference between default and default. Soft default, imagine your mortgage. It simply means, the next few months your principal's thrown into the future. You still honour the debt. The debt isn't forgiven. It's just pushed back into the future. Now, technically, that is a default unless the creditors agree to it. Now, what Berlin is saying is that there may be a possibility now of renegotiating Greece's debt, their debt service and their weight of debt is made lighter, the maturities are stretched out, so that the economy has a chance to breathe again and grow. Because without growth, you don't get those tax revenues coming in, and the ability to pay is not there.
What about the other countries in some strife in Europe? I mean, Ireland's debt is now rated by Moody's as one above junk.
Yes. This is the other issue here, which is obviously political. The people in Greece and the people in the taxpayers in Ireland are carrying the burden. They are in effect paying the creditors to senior bank debt and the debts of their government, of course, which is ultimately held by German and French banks and insurance companies. So Irish taxpayers are expected to have another few years of austerity, and they say this is not fair burden sharing. Why is it not that the creditors should also be involved in the burden sharing through a debt restructuring? Now, up until now, the European Central Bank says that might cause deeper banking system problems. But Berlin is changing its mind slowly.
And meanwhile, Portugal, you feel, will get a bailout despite the Eurosceptics in Finland?
Yes, I think that's almost certain. I don't think the Eurosceptics, True Finn party, can wield enough influence in any new coalition government to stop what happens. I think the real issue now for the Eurozone, if they're going to continue to manage the problem, is to prevent Spain from also becoming the next domino or victim. There has to be a firewall for Spain because Spain is just so big, 11% of Eurozone GDP. It is twice as big as Ireland, Portugal and Greece put together. Over $1 trillion worth of bank-to-bank debt within Europe.
Meanwhile, over the Atlantic, the new sovereign, there are more, credit issues with the sovereign credit of the United States, which is now under threat. And a big reason is the political impasse on fiscal policy, isn't it?
Yeah, absolutely. Standard & Poor's have broken ranks and put a negative outlook on that AAA rating of the US debt, the biggest debt market in the world. Hundreds and hundreds of billions invested in there from foreign governments, Chinese, Japanese, and so on. Yeah, I mean, this is a warning shot to Washington. You can't run a budget with these legislative cliffhangers between Congress and the President. There has to be, it's simply not a way of dealing with the current problem. As long as the budget deficit is 10% of GDP, growth is a lot less than that, debt will inexorably rise. Something has to be done.
Well, do you think, I mean, the bond market didn't flinch, though, did it? Do you think America will take this warning?
It's very interesting. Yeah, the bond market yields hardly moved on the news, and the dollar was pretty steady. Now, what do we read into that? Well, not that the US doesn't have a debt problem. It does, and it's a growing problem. I think it says more about the kind of investors in US debt now. Over half of US government debt is now held by other governments or government-related institutions. And we're talking here, first and foremost, the US Federal Reserve itself is the biggest investor in US Treasury, followed by the Chinese government and Chinese state entities, followed by Japanese government and Japanese state entities, and other Asian governments. It says more about policies than it does about whether this is a good investment or not.
Yeah,
and, you know, the fact that the
Yeah, Randolph, it's always good to get your views. Thank you so much for joining us tonight.